Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is John Huber. He's the managing partner of Saber Capital Management. I've followed John since he wrote the old blog Base Hit Investing. It turns out that started in 2012. Feels like it was only yesterday. I'll be talking to John right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
You know, I remember when Base Hit Investing started. Isn't that crazy? I looked it up just to see when that was, 2012.
Yeah. It's been, it really is interesting. It's been, I guess, 8 years now. So yeah. And you were one of the originals. You were one of the original bloggers that I used to follow, well before I got on my own path. But yeah, it's interesting how the blogs have. There's so many of them now, and I've kind of folded mine into the firm's website. So I still publish and everything, but it's under a different name. But yeah, under Saber now. But yeah, it's. Good times.
When did you set up Saber and the blog at the same time?
I started writing in, I guess, 2012. I set up Saber in 2013, so about a year later.
Okay.
I began managing money in that vehicle in basically the beginning of 2014. So okay. I managed separate accounts, and I started a fund on 1/1/14. The fund is what I have transitioned to recently because for a couple of reasons. One was tax reasons, and one was just the logistical simplicity of managing a fund versus separate accounts. So I about 2 or 3 years ago, I began to merge the separate accounts into the fund, but yeah, I initially was just managing separate accounts, had my own capital in the fund right alongside of the separate accounts, and then rolled those two together in I think 2018. And so yeah, I started writing about a year before that, and really had no strategy for raising money or anything. And
does the blog help? The
blog was a huge help. It really was. Sort of an unexpected benefit for me because, and you know this probably from writing publicly, but you tend to self-select. So if people are reading your stuff and they like what you have to say, they might follow it for a while and they might reach out after a little while. And so I get calls all the time from people that say, oh, I've been reading your stuff for 3 years or 5 years or something. And then they finally, for whatever reason, decide to reach out and they want to invest. And so it's a really unexpected benefit of writing for me was just being able to attract a like-minded group of people to become investors in my fund. And so, yeah, it's been a good thing. I didn't have any expectations at the beginning though, because I really had no idea what, I was pretty naive when I set it up. I had no idea how I was going to raise capital. I had no strategy. I had a very specific goal of wanting to set up a fund and wanting to, try to pursue investing and try to produce good results and everything. But my philosophy was always very simple. If I do well, I'll compound my own capital, if nothing else. And then hopefully I can find some investors to hop on the ride along the way. And so that was sort of my approach.
Why did you start writing in the first place?
Well, I started writing. So a couple of things. One is I've always written a lot, just like personal, diary or whatever, business diary, investing journals, and so forth. So I've always found a big benefit in writing down your ideas because it forces you to crystallize that idea, and it also forces you it helps you recognize flaws in your thinking, helps you clarify thought, and so forth. So it's been an exercise that's been really helpful for me. And so yeah, I've decided to just start writing publicly because I thought, number one, it's what I've always done. Writing is a good exercise, but number two, maybe I can connect with other people. It's investing is kind of a solo sport at times. So it's nice to connect with other people, and it's nice to, I've met a lot of friends that way. And so I that was the other reason, just for social reasons, really. And to also get feedback, right? So if you write something publicly and about a certain idea, you might get some feedback. Somebody else might recognize a flaw in your thinking. So that's been a big benefit as well.
I don't always start the podcast like this, but I think we got a pretty good flow, so I just keep on going if it's all right with you.
Sure. Yeah.
I couldn't agree more.
These AirPods. These AirPods does the sound quality? Does it sound okay?
Sounds fine.
Yeah. Okay.
Yeah, I couldn't agree more with the writing. I wrote because I think it's a good exercise just to crystallize. You don't really know what you think until you write it all down. Sometimes you get to the end and realize that doesn't make any sense. So just that one never sees the light of day. But then it's good to be able to look back after a long period of time and see what you were thinking and how that's evolved. There's a small trap though when you're writing publicly, in that you may feel this need to sort of maintain that consistency about an idea. You've written publicly about some of the positions that you have on your blog. So you've got Foot Locker, which seems to have been a pretty prescient. I think you wrote that about 5 years ago, where you said, is that right?
Yeah, I think
was
if you're referring to, it was an interview with
Forbes.
I think Forbes,
yeah.
and I mentioned Foot Locker as an example of a business that, I think it was an interview, but I think I know what you're referring to, and it was just a business that I thought faced headwinds. So
you said it was cheap on the metrics, but you thought there were problems with the business, and so you thought, well, it looked cheap at the time. The problem would be that it would continue to deteriorate, and then it might have this, I think, waterfall or some big drop at some stage, which has turned out to have been, it hasn't gone anywhere over that entire period of time. It's probably down.
Yeah. Well, I mean, so first off, sometimes you get it right and sometimes you get it wrong, and that maybe that was a nice one to cherry pick. So maybe that one is right. But yeah, one thing about that concept in general is, there's been a lot of talk about value investing lately versus growth investing, for example. And what's interesting is, one of the things I love about investing is there's more than one way to skin the cat. So, I've read your books, Toby, and you're a clear thinker. You have a quantitative approach, I think, and it's a very value centered approach. And there are a lot of guys. I have a lot of friends that run funds that are successful. And then at the other end of the spectrum, there's this growth. People like to put style boxes around value investing and growth investing. To me, it's the value of any asset is the future cash flow that you're able to pull out of it. So that's kind of how I think about value. But yeah, it's interesting. The last couple of days, we've seen sort of a minor resurgence in value. So we'll see if that begins to close this gap. But
there have been lots of minor resurgences over the last decade.
Yeah,
needs to hold for more than a week or so.
Right, exactly. Yeah. But I think one of the problems, and I brought it up to say, Foot Locker kind of fits this bill, is the problem I see with, again, when I say value investing, I'm using the conventional definition of low price to earnings, low price to book, certain things like that. I think some of the metrics that you've espoused over the years, like enterprise value to pre-tax earnings and so forth, are probably a better measure. But even those measures are, of course, proxies for what you think the business is going to earn in the future. So as a guidepost, you might look at those metrics and as a proxy for what those companies are going to earn going forward. But what the company earned last year is irrelevant to its value. It's all about what it's going to earn this year, next year, year 5, year 10. And so, if I buy a shopping center, I don't care what it earned last year. I'm obviously going to look at the net operating income and figure out what, use that as a proxy for what the revenue and the earnings and the cash flow might look like this year and next year. But, what the last guy earned is irrelevant to me as a new buyer of that asset. So I think that's where value, the issue is, it worked for so many years because those proxies, the earnings that the companies earned last year, were good proxies for what the companies earned this year and next year and the year after. But I think as the economy has transitioned from a manufacturing economy to more of a services economy, and then within the last 20 years to more of an information-based economy, they call it the internet economy or whatever, which is sort of a subset of the services economy. We've had sort of a shift I think a shift in how, number one, like price to book ratio doesn't make a lot of sense anymore because companies can now produce their earnings without a lot of tangible capital. And then price to earnings is much more useful, I think. But again, it's a guidepost because things change. And so I think you have to just be a forward-looking investor if you're a qualitative type investor like I am. If you're quantitative, I think as a basket, value investing always makes sense. But if you're a stock picker and you're thinking about things qualitatively, I think you have to spend a lot more time analyzing what it's going to look like, going forward. So, with Foot Locker, that's an example of one that you could see problems developing with that business. And
what did you identify at the time? Do you recall?
Well, with Foot Locker, one issue, it was just simply that mall traffic was declining. And so there's a trend towards, in many businesses towards cutting out the middleman, I think. And Foot Locker is a middleman. And so they're struggling for two reasons. One is it's a lot easier for a company like Nike to go direct to consumer, or Under Armour or any other brand. If you have a brand, you can go directly to the consumer in a much easier way than you used to be able to. You used to be able to need these distribution outlets, stores, in other words, to sell your merchandise. And now those are still important. I don't think those are ever going to go away completely, but certainly Nike, number one, Nike can set up its own stores, and a lot of the brands have been doing that. But also obviously the e-commerce and being able to sell your goods and your services online becomes a much more efficient way to transact directly with the consumer. And then, as I mentioned, the mall traffic was just a headwind because a lot of this, in that particular case with Foot Locker, a lot of their traffic came from mall traffic, and mall traffic, unfortunately for mall tenants, is declining. So that was sort of a headwind that I thought was one of these secular headwinds that probably isn't going to change anytime soon.
You've got an interesting background in the sense that you came from real estate development before you were an investor, a value investor. Does that help with that sort of assessment at all? Or what sort of property development were you doing before you were an investor?
Yeah, I did. So I didn't really do development, but I did real estate investing. So I started, I have sort of an unconventional background. I got into this business in a roundabout way, but I've always loved investing. So I always wanted to get into basically do what I'm doing now, running a partnership. But
and you got the Buffett style partnership 0625, right? We'll come back to that, but I just want to let everybody know there's no management fee. It's just a carry over a hurdle.
Right. Yeah. It's a no management fee. It's a 25% carry over a 6% compounding hurdle. So I started Saber in 2013, and before that I spent about 8 or 9 years in real estate investing. And we and to back up a little bit further, I went to school for journalism, and so completely unrelated to business, obviously. Although it's interesting, as I look back, I didn't know this at the time, but there are a lot of similarities between the skill set that you need to be an investigative journalist and the skill set that you need to be an investor. Again, at least the type of investing, the type of research that I do. So it's very similar. The objective is different, right? You're writing a story, or you're trying to report facts as a journalist, but as an investor, you're trying to determine if a security is mispriced. So that you come to a different conclusion, but the effort and the research process is very similar, actually. So I've always loved that aspect of investing, sort of the treasure hunt aspect of investing. And but sometimes in life, timing isn't ideal. And in school, my senior year, I began studying about Buffett, and I've always been interested in investing. My dad was a very avid investor in his own account. He was an engineer, for Delphi, which is a part supplier for General Motors. And he spent his career there, and he invested actively in his own account. And he did very well. He is a very good investor. And I always thought I'd sort of take that playbook and have a career, invest my savings as more or less a hobby, just because it's something that is intellectually stimulating. It's fun. I like the process and so forth. But I began studying Buffett. I picked up a book in the library one day, and again, this was toward the end of my time in school, and so I had a decision to make. I got very interested in investing to the point where I decided I wanted to pursue business as a career in some form, and I naively began studying Buffett's partnership letters, and it led me to Graham and Dodd and all of the classic texts that everyone talks about. And I say naively because I looked at his structure and I thought to myself, that's a really good, the partnership structure that Buffett set up in the 50s. He started with $105,000 and, had like 6 or 7 family members that were investors, and he worked out of his house. And, it was just a lifestyle that seemed appealing. And so I thought, I'd like to try to replicate that somehow. And again, I'm not talking about replicating his results, because I don't think I don't know if Buffett's results are replicable, but certainly the structure that he had, I thought that one could emulate if given the right conditions. So that was my goal. I had no idea how I was going to get there, but I became interested in business, became interested in real estate specifically. And long story short, a friend of mine and I decided to set up a small partnership in 2006, and we began. So, and this is where a lot. So timing on the career decision was not great, because I had just finished school. Timing on this, I was much more fortunate. So the real estate market began to crack in 2006. I think housing starts reached 1.8 million in January of 2006, which was the historic peak of the housing market. And fast forward a year and a half later, and housing starts were cut in half down to 900,000. And so the foreclosure boom really began in the fall of 2006, early 2007. Of course, subprime crisis hit in 2007, and then Lehman in 2008, and the rest, we all know that story. But it was really a once in a generation type of an opportunity to buy single family housing as an asset class, and then also multifamily housing. So my partner and I did residential investing in the single family and multifamily sectors. And we did things on a very small scale. So it was all our own money. We had a couple investors, but primarily a small, sort of very small focused group of investors and our own capital. And we would cherry pick these incredible bargains. And I always tell people I was like more of a Graham and Dodd investor in the real estate market, because we would buy 50-cent dollars, and we were able to sell them. We'd be able to shine them up a bit and sell them once they were stabilized. And so we would buy, like, we bought a 12-unit apartment building that was 50% occupied, stabilized it, leased it up, and then sold it. We did a lot of things like that on a very small scale. We built up a small portfolio of, I think, 20 units at the peak, and that enabled us to, that enabled me to collect cash flow, finance my living expenses, and then also the most important thing for me was, as I thought about, should I go back to school and get an MBA? Should I go to Wall Street? Should I go try to work at a fund? How do I get into investing as a business, or how do I get into the field? And the overriding, as I made my pros and cons list, the overriding factor that rose above everything else was autonomy. And so I really, I just didn't want to go get a job, Toby. That's what it really came down to.
I understand that.
I really valued there's two things. I view investing as a lifetime game. And, there's two parts of the equation. There's the economic compounding, which is the obvious objective of investing, trying to produce great results over time and compound your money, and money compounds over time. But the other thing is getting better at your craft. So knowledge, some people call it knowledge compounding or whatever, but basically the idea that, the more time you spend, the better you get. And so I actually, the most satisfaction I get out of this business is the process of trying to continually get better at my craft, the craft of investing, so to speak. And so I didn't want to, at that point early on in 2005, 2006, I didn't really want to go work for someone else where, I'd have to spend 70 or 80% of my time doing something that someone else directed. I wanted to allocate the precious resource of time in the best way that I saw fit. And so I was able to, I earned a lot less money in the early years, but I think of it as a sort of a longer term investment in, learning what I wanted to learn and reading what I wanted to read and developing that skill set. So real estate was a way for me to do that. So long-winded answer to a pretty simple question, but yeah, that's what got me from sort of there to developing the partnership or starting the partnership about 8 or 9 years later in 2014.
When you're transitioning from Graham and Dodd style real estate, and real estate is already, if anybody who's looking at real estate is probably closer to the Graham and Dodd end of the spectrum. But when I look at the positions that you've written about publicly, I don't know necessarily whether you hold these or not. These are just companies that you've written about. And you've written about Tencent, you've written about Facebook, Markel, Berkshire. These tend to be at the growth, well, maybe not Berkshire so much anymore, but certainly Markel and these other ones are at the growthier end. So how do you transition? How do you evolve as an investor to get to those points?
Yeah, it's an interesting question. Yeah, because in real estate, it's the asset is a commodity more or less. So there's not a lot of the way to make real returns in real estate is either through development or through sort of an activist approach. In the public markets, we might call it like an activist approach, where again, you take an asset that's underperforming and you get it up to speed. So there's an operational component to real estate. If you want to make outsized returns, that's how you do it. Or you get lucky like I did, and you find yourself in the midst of one of the greatest, bear markets in the history of real estate, which is really all that was. It was more, better to be lucky than good is the saying. And that's really what it is. So I don't think we'll probably ever see a real estate market like that. I mentioned those housing starts. They fell all the way from, I think 1.8 million was the peak, but they dropped down to 400,000 in 2009, and they sort of bounced along the bottom for a good 2 or 3 years. And so there was a 5-year period where you could buy, banks were in this liquidation phase, and you had this extreme oversupply coupled with an extreme decline in demand. And so it took years. In fact, just what's interesting about the real estate market or the housing market is just late last year in December was the first month in 12 years that we hit 1 million starts on a seasonally annualized basis. So it took 12 years to get back to what would be considered by most real estate observers consider 1 million starts is sort of the equilibrium number that you need to support population growth. So we have 330 million people and population's growing at 1%. You need, 3.3. You have 3.3 million new people entering the world each year, and there's 2 or 3 people in a household. So you need 1 million new houses just to sort of keep up with that. It took a decade plus to get back to just equilibrium levels. That's how oversupplied we were. So it was really a really once in a generation type opportunity. So I sort of say that as a background to say it was quite easy to be a Graham and Dodd investor in 2008, 2009, probably in the public markets too. I mean, I was following the public markets. I was investing my own personal capital. I wasn't running money professionally at that time, but I was, there were a lot of bargains around everywhere, right? In the stock market, there were bargains in the real estate market. And so it was easy pickings at that time. If you think about, so to answer your question on why is it different in the public markets, or why is my approach different? I really think of investing as, if you think about the very simple elements of the transaction, providing a company with capital So if you could think of it in terms of like a small company that you're investing in, a startup company, or even a friend's small business or something. If you invest capital into a venture, your objective is to achieve a return on that capital. And so you will judge your success, other than any intangible factors like helping someone out, or helping your friend get started or something. Most people will judge their success based on the return that they achieve on that capital investment. And so investing in a business is the point of investing is to achieve a good return on capital, and the same objective exists inside of a business. A good business can earn high returns on capital. And so when I look at the stocks that have generated the most wealth over time, they tend to be, they're very rarely like these bargain basement Graham and Dodd type stocks. They tend to be companies that are high quality companies that earn high returns on capital and are simply going to earn a lot more money in the future than they are now. Or if you look back in the rearview mirror, companies that have generated a lot of wealth tend to be companies whose earning power has increased dramatically over the last 10, 15, 20 years. So that's a very simple observation. Good companies make good investments, and it's something that your grandma in Iowa can easily understand. And so it's a very simple concept, and it's the concept that I employ. And so when I think about the margin of safety concept, I think the margin of safety comes in large part due to the quality of the business, as much as the perceived gap between price and value at any given moment, because business is dynamic. So if you think of yourself as a part owner of the company that you're invested in, you're paying that management team to act in a certain way and to adjust to changes. And we live in a world where change is much more pervasive than it was 10, 15, 20 years ago. And so those are things you have to think about as an investor now. And I think I'm personally more comfortable investing in companies that are good at adapting to those changes and are good at utilizing the capital that they employ effectively. And margin of safety comes from a company that the earning power is going to increase going forward. So that's why I prefer the companies that tend to be on the growthier end of that spectrum. They tend to grow into their valuation. So they're much more forgiving. I found that mistakes tend to be made a lot more on valuation than if you pick the right business, as Buffett says, you pick the right business, you're going to make a lot of money over time. So I think the mistakes I've made have been more when I've focused more on valuation, the static valuation of an enterprise versus what I think the company's going to look like, say, 3, 4, 5 years down the road.
So let's just talk about that a little bit. How are you making that assessment? How are you thinking about valuation when you're buying something? Are you you're thinking 3 to 5 years down the road, what do I think this thing can be generating in terms of free cash flow? And that's what I'm looking at now. Is there some hurdle that you're trying to meet at any given point in time?
Yeah, there's a hurdle that I try to meet. I mean, I have an objective in mind. So I kind of work backwards, sort of a reverse DCF of sorts. But yeah, the simple explanation is I think of it in terms of future free cash flow. So I will do a DCF at times, but it's typically very simple back of the envelope type thinking, and I try to do the analysis and then figure out what I think this company looks like in, say, 5 years. And I think much beyond that is very difficult because things can change so rapidly. But I think on the rare occasions where I have an insight on what the company looks like in 5 years, and that insight differs from the market, is where the opportunities are. And those are, in my case, few and far between, but they do appear once in a while. And so I try to look at what I think the company's going to earn 3, 4, 5 years down the road, and then work backwards to determine, the return that I'll get at this particular price. So, you capitalize those earnings in year 5, and you can work what is that worth? What's the company going to earn in 2025, and what does that look like? What is that worth to the market? And then you can work backwards to determine, the return that you'll get. So that's the end game. But most, 95% of the work is understanding the company, understanding the threats, figuring out, how it's going to adapt to changes and risks and so forth. And so most of the work is spent really taking my time reading about companies and watching them over the years and observing how they operate and understanding their competitive advantages and their risks. And then, at a certain time, the market gives you an opportunity to buy things at a certain price. So the process for me is I create a watch list of these companies, and then I just wait for, I have valuations on each company, and then I just wait for the market to give me a valuation that makes sense to me.
And when you find them, how much are you looking to allocate to any given company as a proportion of the portfolio?
Yeah, that's an interesting question, because I think portfolio management is a big part of the equation. So I've always thought that the simple concept of value investing is easy for everyone to understand, and it's very difficult to implement. And again, for my type of investing, I think there's just not that many great ideas. And so I think a lot of investors have 2 or 3 or 4 really good ideas, and then they water those 2 or 3 or 4 ideas down with, 15 to 20 other ideas. And that tends to dilute the value of those few great ideas. And so I try to, as best as I can, eliminate the ideas that dilute those few ideas. And so, it's a long way of saying it's a concentrated portfolio. In the ideal world, I'd have 20 stocks and they'd all have an equal, roughly approximately equal risk reward. But in the real world, it doesn't usually work that way. And so it tends to be a very concentrated approach. And there's more than 2 or 3 or 4. I typically have between 5 and 10 stocks in the portfolio at any given time. So it's quite concentrated. But it depends on the situation. So sometimes a starter position might be 5%. Sometimes it might be 10%. And then on the rare occasions where there's high conviction, it can be, upwards of 20% of the portfolio. And the biggest positions in my portfolio tend to be the ones where I'm most convinced or most convicted in the risk reward. And I guess more importantly, the biggest ideas tend not to be the ones where I think might have the most upside, but have the least downside. So that's kind of how I think about position sizing.
Go ahead.
I was just going to say the wider range of outcome. If you have a stocks have a certain range of outcomes. I think about it like a barbell. So on the left, if you picture a barbell, on the left side of the barbell, you have what I consider to be like the real defensive names, the really durable names. So the Berkshires of the world. The range of outcomes is quite small for some of those types of companies. They're very defensive. They're very economic. Berkshire is somewhat economically sensitive, but it's a very stable business with a strong balance sheet. So other companies in that list might be like Waste Management or something. Like if you're a trash collector, your revenues are fairly predictable in any given year, and therefore the outcomes are fairly narrow. So I don't tend to invest a lot in those, but as you move your way down the spectrum from the left side of the barbell to the right side, at the other end of the spectrum, you have more of the cyclical companies that have a wider range of outcomes. So like an oil refinery, for example, doesn't control the cost of its input, doesn't control the cost of the product it sells, and therefore the margins can be all over the place. It's a very volatile business. And therefore the stock price is very volatile. So I don't really invest at that end either. It's sort of the opposite of, I think, Talib's approach, where he says, invest at both. I'm kind of more in the middle, where I think of 2 categories in the middle of that barbell, which are more of the secular growth businesses that have a durability to their business, and are very likely going to be doing better in, say, 5 to 7 years than they are now. And then maybe more of the fast growers. So those are like the durable growers and the fast growers, which have more of a wider range of outcomes and are more economically sensitive, but have, more upside potential possibly. So those are sort of where I like to look for investments. But the bigger positions tend to be on the left side of the barbell, and the smaller positions tend to be on the right side of the barbell because of the distribution of possible outcomes.
The narrower the distribution of possible outcomes, the larger the position tends to be, and the wider the distribution of outcomes, the smaller the position tends to be.
That's how I think about it. Yeah, I really think about it in terms of downside. So, in theory, you could have something with a wide possibility of outcomes at a certain valuation, where the range of outcomes exists more on the upside, and that could be potentially a bigger position. So it just obviously depends on price, but that's generally how I think about it.
If you size something to 20% at inception and everything goes right and the position gets very big, do you trim them back to, how are you thinking about it on a sort of continuous basis? Are you trying to trim them back to their appropriate risk weighting in the portfolio? Is that a valuation question, or is that some other consideration?
Yeah, that's when I really struggle with, Toby. It's selling has always been a difficult proposition, because if you invest in an operating business, I really, in an ideal world, someone was talking about this the other day, like the coffee can portfolio, where, I don't know if you're familiar with that concept, but basically, if you're an individual investor, it's really a great way to invest. You pick one stock a year or one stock every so often, and you put your savings into it after you've spent a careful amount of time researching it, and you put it in the coffee can, so to speak, and you forget about it. And then every year you add to it, and your results, I think individual investors probably improve their results if they thought that way. And I think as professionals, and again, at least for my type of a longer term, low turnover approach, that approach works. So the problem is, when the stock appreciates, if you have a 20% position, and this is, a first world problem to have, but if the position goes in your favor and it becomes a 30% position, what do you do with it? For me, I tend not to trim those positions unless the valuation gets, to a level where I consider it to be significantly stretched, or my future returns are going to be, worse than cash, for example. I always tend, I've learned from this, because the best investments I have made, I've tended to trim things too early, and that has reduced, unfortunately, the returns that I could have achieved. And in hindsight, when you think a stock reaches its fair value, I've often found that, in hindsight, it still was undervalued. So I tend to think about it in terms of opportunity cost. So if the position gets to a market, what I consider to be a market return going forward, or sort of an opportunity cost, let's say the S&P is your opportunity cost, and let's say that's 7%, just to put a number on it. If a stock gets to a level where your future returns are going to sort of match the market, I'll tend to hold those until they get to a level where I think, I might actually lose money at this level. So if the stock gets overvalued, because again, I've learned that the best businesses tend to often look overvalued, and they still are oftentimes fairly valued, or in some cases they're still undervalued. So unless something gets egregiously overpriced, I try to do my best to not trim things.
Yeah, there's a great story about Claude Shannon, who was the father of information theory. And he worked at Bell Labs, had an association, I think, with MIT, and so it got to invest in a lot of companies very early on. Motorola and so on was one of them. And he'd put the money in and then never touch it. And so by the time that he passed away, I think it was Motorola was like 88% of his portfolio, because it had gone so well. But everything else in his portfolio had performed as well. It was just that Motorola had been such a spectacular return. I forget the numbers, but they're just silly numbers, like 100,000% or something like that.
Right. Yeah, and so that, at that level, that's an extreme example. And again, it's in the coffee can. The reason you put the stock certificate in the coffee can is you just forget about it. You lock it away, put it in a vault somewhere, and just don't think about it. And that's sort of what he did with Motorola. And there are fund managers that have implemented approaches that resemble that coffee can idea, which I really love. But it's very difficult as a money manager to do that, I think. I don't know what your thoughts are on that, Toby, but it's hard, because if a stock gets to 88% of your portfolio,
your fortunes are tied to that stock.
Yeah, your fortunes are tied to that stock, and any incoming investor is they're basically buying that single security, and so you're going to have a more volatile approach. And so the reason why, and this gets more to a fundamental, sort of the concept of edge. I think a lot about this is in investing, volatility is something that almost every investor tries to mitigate to a certain degree, and it's very difficult to do that. And it's understandable why people want to mitigate volatility. Volatility can be painful, and we're coming off a stretch here where we've gotten a healthy dose of that. And it is interesting because in the public equity markets, volatility is just the nature of the beast. So trying to mitigate that is a very difficult thing, and I think in most cases it's an impossible feat.
It probably reduces returns too.
I was just going to say that the way to reduce volatility is to sacrifice returns, and so the converse of that is the way to produce great results in the stock market requires the price of volatility. That's sort of the price of great long-term results, is the willingness to take volatility. So there are some fund managers that have done that successfully. Ted Weschler is one who he before he started to work for Berkshire, he ran a fund that did phenomenally well in a decade where the stock market did literally zero. I think he started his fund in 2000 and he wrapped it up in 2010, and that decade was essentially a lost decade for the S&P 500. But he did, I think, 25% returns or something during that decade. It was just an incredible stretch, and it was largely due to two stocks that he bought in the very early years. One was DaVita and one was W.R. Grace, and same sort of thing. I mean, he bought those. They were big positions at the beginning, but they became huge positions. I think when he wound up his partnership, one of the two was 50% of the portfolio. So I don't know if I don't really know the details. I don't know if he trimmed it along the way, but it became much bigger than his cost basis. And a large part of his returns were due to those two decisions that he made early on. So a number of lessons in there. You don't need that many great ideas to produce great results. And when you find the great ideas, you should stay with them as long as possible. But it's difficult to run a fund that way because people are sensitive to volatility, and naturally you're going to have more volatility as your concentration level increases.
And you've also got the problem that it's got to be run continuously with an eye towards what is coming in the future for every investor, who's not just because the investors are incoming, but because you don't sort of live on your past record. You're always trying to position for what's coming in the future.
Exactly. And it's difficult to do because in the short run, and I would define the short run as 1 year, 2 years, 3 years even, it's, I don't think anyone can outperform every year consistently for many, many years. I think you have to, I mean, if you run, I guess, Jim Simons did that. So maybe it is possible. Maybe you can come up with a strategy, Toby. You're a quant guy, so it's possible for you.
I'm a value guy who does some quantitative stuff. The quants won't have me.
Yeah. So it's to me it's again the price of long-term results is the willingness to withstand volatility and underperformance. Right? Volatility is sort of a euphemism. It's underperformance in the short run is the price that you need to pay to get great outperformance in the long run. So unless you want to hug the S&P, to produce results that are significantly better than the S&P, by definition, you're going to have to do something differently than the S&P. And sometimes, unfortunately, that means, hopefully over the long run, differently means good, but in the short term, differently can sometimes mean bad.
Can I talk to you about a few of the positions that you've written about publicly? So Markel and Berkshire.
Sure.
I think they've both got unusually cheap recently, and that the businesses are, as you say, maybe a little bit more tied to the fortunes of the economy than other businesses, but still both exceptional balance sheets run by exceptional managers with an eye to the very long term. Markel, of course, is an $11-12 billion company. Berkshire's a $440 billion company, so Markel, and run by a 58-year-old rather than a 90-year-old, so a much longer runway. But can you just talk through those positions and where you see them now?
Yeah, they're both really great companies. I don't happen to own either of them right now, but they do. Berkshire appears to me to be cheaper than I think it's ever been since 2009. What's interesting is, and this is something as I watched the meeting at the CenturyLink, which was just sort of an odd experience. I don't know if you watched Buffett's annual meeting, but he's in the CenturyLink with like 5 people, and the place is just totally empty. So very conducive to social distancing in that particular venue. But it was very odd that he said a couple of things. One is obviously the takeaway was he seems quite bearish on the stock market and the economy.
I've never seen him like that before. He's always, to me, extremely optimistic.
He seems extremely, he has been optimistic, I would say, for the last probably, 15 years. He was very optimistic during the last crisis. One of the things he said, he had the never bet against America theme, which I think is absolutely right. In fact, I was reading this book by Ellen Greenspan, I'm reading it currently, and this sounded like something Buffett would cite, the statistic. But in 1776, I think there were 3 or 4 million people here in the U.S., and the output of per capita, per head of that group of people was about $4 a day in 2020 dollars. So in current dollars, our GDP per capita essentially was around $4 a day, and now we have 330 million people, and the output is around $130 a day or something in that ballpark. So, we've seen, what is that, a 32-fold increase in real GDP per capita. It just shows you the power of the productivity, or just shows you the productivity gains that we've achieved and the standard of living increases that we've had in this country over a relatively, in the scope of history, a relatively brief period of time. So I think Buffett's right. Never bet against America. The tailwind is too great. But yeah, he definitely seems cautious, to say the least. But I was thinking about it. He has been bearish in the past. He was bearish in 1999. He gave a famous talk in Sun Valley and was essentially booed off the stage when he gave that talk.
Is that true?
I don't think literally, but I mean, people were in Snowball. The book by Alice Schroeder, she opens the book, I think, or very early in the book, has a section where, a lot of the technology guys were there, and they were kind of, whispering under their breath as Buffett was warning about the lofty heights of the stock market at that time. So I think he predicted that stocks would return like 4% a year over the next decade. And that actually proved to be optimistic. People thought it was dire, and they thought it was, way too pessimistic. If you looked at public opinion polls in 1999, people were expecting 13% returns, 15% returns, over the next decade, like they just saw in the previous decade. And when Buffett said 4%, it was just a way out of consensus view. And again, that decade turned out to be even worse than that prediction. So I think he was bearish in 99. And I think he was bearish in the mid 80s during the merger boom. So in Lowenstein's book, there's a spot in, which is the first bio, which was written in the mid 90s. There's a few chapters that talk about the merger boom, and stock prices started getting out of control because at that time companies were trading. So coming out of the bear market in the early 80s, companies were trading well below replacement value, and we had significant inflation. And so real assets were appreciating in nominal terms. And you had Volcker, the Fed chairman, sort of famously broke the back of inflation, and then you had interest rates coming down, and it led to cheaper money. And there were a number of factors that kind of led to this merger bonanza. And it inflated stock prices to a level where I think Buffett just became uncomfortable. So he didn't make, if you go back and read his, look at his annual letters from the mid 80s, I don't think he bought a single security a single stock between 1984 and 1987. And so there was like a 2 or 3 year, maybe it was 2 year period, 85 to 87. He didn't do much of anything.
And he wound up his fund too, I guess, that was 69, right? The fund.
Exactly.
So he must have been quite bearish then too.
Yeah, I think he was bearish in the late 60s and he was bearish in the mid 80s. In fact, he actually sold stocks in a pension fund. And again, this is in the Lowenstein book, which is kind of remarkable, but he actually sold stocks prior to the crash. I don't think he sold he didn't sell his positions, his core positions or anything, but he sold some smaller positions that were sort of in some of the pension funds that Berkshire's insurance subsidiaries managed prior to the crash, because I think he was worried about the level of the markets. Of course, then he was buying hand over fist after the crash of 87. And then I think that was really the point where he became more of the buy and hold forever. So he bought Coca-Cola, I think in 87 or 88. And, that was really the first. Washington Post he's never sold, but there have been some others. But really that was the beginning of what I would call the current Warren Buffett mantra, which is sort of buy these stocks and hold them forever. And of course that doesn't hold true for every position, because he still sells things when he makes a mistake. It's one of the most underrated aspects of Buffett, I think, is his ability to change his mind when he's wrong. And he evidenced that with the airline sales.
IBM.
But IBM, Tesco, the grocery store in the UK, was a relatively smaller position. He sold those. So he does sell things, I think, when he realizes he made a mistake. But yeah, he seems bearish. But yeah, I guess back to Berkshire itself as a stock, one of the things that was interesting about the meeting is he stopped buying back shares in March, which was really surprising, because he has always said that he's always sort of benchmarked intrinsic value somewhat to book. So he's always sort of tethered his estimate of intrinsic value to book value in some way, and he's adjusted that slightly over the years as book value has become less.
It's gone up,
right.
And he's more recently. The last pronouncement was basically, we're going to ignore book value. We're going to make it our own assessment of that, which to me said it's going to be even higher than 1.3 times book or whatever it had been in the past.
Right, and that makes sense, because the railroad that he bought in 2009 for $26 billion is probably worth $100 billion today, but the assets are still held on the books at the price that he paid in 2009. So it certainly makes intuitive sense that book value has become less tied to intrinsic value. But what's I guess unique about this particular time is he was buying shares in January and February at 1.3 times book, and then he stopped buying at a level that got as low as I think 1.15 or so by my estimates. And it's hard to know exactly what it was, but just sort of adjusting for the markdown in his $250 billion stock portfolio. And you can kind of get a rough estimate of what the price to book ratio was in March at the bottom of the market. And so my conclusion on that whole thing is I think Berkshire is extremely cheap, but I think Buffett is cautious, because I think he doesn't want to see the boat that he's spent 50 years building start to develop holes, when he's 90 years old. He's said many times in the past, he's talked about all sorts of different debacles, like the LTCM debacle in the late 90s was a famous example of sort of greed gone haywire, or greed on steroids or something, where so much leverage was used by extremely smart people to produce more money that they didn't need. He's got this quote that basically says, once you're already rich, you don't need to get rich again, basically. And so I think the issue with Berkshire right now is he could, and this is just my complete speculation, I don't know that this is the case, but I think he could be looking at the environment and seeing potential for significant litigation in business interruption insurance, potentially workers' compensation, which Berkshire is a big underwriter of. And I think like there have been some court. In fact, there was one court case in France last week where AXA is going to have to basically the French court ruled that they're going to have to reimburse certain restaurants for 2 months of revenue. And so, I think if you start to violate contract law, and even if it's clear that these contracts do not, pandemic is
it's carved out.
Is carved out. It's if you're just gonna start to override that, then who knows? How do you handicap that? Who knows what the losses could be? I mean, it could be $100 billion. And I think Buffett has said before that Berkshire is fit to withstand a $250 billion hurricane season, or even more, and which would be multiples of the worst hurricane. I forget what the damage Katrina caused, but it would be multiples of that. And Berkshire wouldn't even see any hit to its capital. So it's an extreme fortress, and I don't think there's any doubt it still is an extreme fortress. But I think when you have the uncertainty of the pandemic, possible litigation, it's hard to know what the claims will end up being when the dust settles from this. And he said at the meeting, the other thing he kind of said, it didn't get a lot of publicity, but I think he tipped his hand a bit when he said there's no law that says a major storm can't come during a pandemic, right? So if you have a Katrina this summer and you combine it with all of the possible claims from the pandemic, it could be sort of a once in a 500-year flood. And I think he just wants to be prepared for that. And I think he probably views that as a tail risk that's probably got 1 or 2 or 3% or even lower odds. But I don't, he said before that he doesn't want to take even a 1% chance of something bad happening. So I think that's more likely the reason why he wasn't more aggressive in buying stocks. But that's just
as opposed to him thinking that there might be another leg down or there might be another opportunity. You think it's more of the risks that he's seeing now.
Yeah, I really don't think he's timing the market. I could be wrong on that. The other school of thought is he's close to Bill Gates, and I've been following Bill Gates. The blog that he writes has been very interesting in learning about the epidemiology of this virus. But I don't think. I mean, it's possible he's looking at it and saying there could be another leg down. But when you have $137 billion in cash, for him not to buy, not to use 10% of that to buy stocks is quite surprising. It would be abnormal for him not to be buying when the S&P is down 35%, and you could be buying stocks that you liked.
You can buy your own stock.
Buy your own stock, right? If you liked your stock at 210, why aren't you buying it at 160? The idea that the intrinsic value, he said, somebody asked him that, and his answer was the price to intrinsic value hasn't changed.
I found it a little confusing when he said that. Honestly, I wasn't sure whether he was referring to 210 or closer to the bottom. Yeah, sorry.
Yeah, well, that confused me as well, because the price to book, it's hard to reconcile that, because the price to book was lower in March than it was when he was buying shares in January. So, it tells you that either his view of the intrinsic value of the business itself has gone down, and that certainly could be the case. The pandemic was a game changer. And so, maybe the railroad is worth less. Maybe the utilities are worth less, although that's hard to imagine because the utility is more of a recurring cash flow business. And the intrinsic value of any asset doesn't change all that much by what happens this year. It changes a lot by what happens over the next 5 to 10 years. But, a downturn in earnings, a cyclical downturn in earnings doesn't change the values by all that much, yet stock prices were down, 35% on average and up to 50%. So it's hard to reconcile that. The only explanation is he believed that book value was overstated or intrinsic value had gone down.
The explanation that I like the most is that if you have a range of outcomes and you have some valuation that's based on a range of outcomes, if you introduce a new outcome or you put some more weight on the lower end of that spectrum, that will naturally pull down your intrinsic value estimate. And that seems to be the way that Buffett thinks. He doesn't want any possibility of the having too much weight in the lower end of that spectrum of outcomes manifesting. So he's always trying to avoid the worst possible outcome rather than trying to capture the best possible outcome.
Yeah, I think that's it. And that's sort of what we were talking about with the pandemic risk is, when you introduce that new risk, however remote that risk is, it's going to have some element of lowering your intrinsic value. And so if there's a risk of $100 billion industry-wide claim, then you have to account for that. And really, I think that's what I don't think he's doing anything fancy in terms of trying to get too precise with this. I think he's just saying, hey, there'll be more times to buy stocks. I want to make sure that the painting that I've spent my entire life painting or putting together doesn't start to develop cracks. And so I think he's just more thinking about the downside. And then the other side of it is private business fallout hasn't occurred yet. So in terms of private deals, he just hasn't had enough opportunities. So he sort of lamented the fact that the Fed came in. He didn't lament the fact.
He was front run a little bit by the Fed, where previously they've performed that role for bigger businesses. Yeah,
exactly. I mean, he has sort of played the role of J.P. Morgan, the man. J.P. Morgan famously bailed out the financial system in 1907, and Buffett sort of did that in 2008. Not exactly, but he was able to provide capital, whereas the Fed, it took the Fed 6 months or so in 2008 to really enter the picture. They did some minor things in the fall of 2008. They did some major things in the fall of 2008, but compared to what they did this time, it's pretty remarkable what they've done. So I was just looking at the Fed's balance sheet just last week, and it's, they've put $3 trillion into the financial markets in 6 weeks. It's been, I mean, it has absolutely been unprecedented, despite the overuse of that term in the last couple of months. It really has been remarkable what they've done. So yeah, I think Buffett has always been, he's always lamented private equity as a competitor, and now he's got the Fed. And so it's a tough game for him. So, but Berkshire itself is a stock. We've been chatting about the company, but the stock itself does look cheap. I think the reality for Berkshire is it exists on the far left side of that barbell that I described earlier. And I think there are better ideas out there than Berkshire Hathaway as a stock investment, but it's a great company. And
How do you think about Markel in that context?
Markel, I think, Markel is a great company. It's run by a great CEO, Tom Gaynor. And, I've had the chance to visit Markel. I've met with Tom. He's a great guy. He's an excellent steward of capital, shareholder capital, and it's going to continue to do very well. I think it operates a similar business. Obviously, it's in the insurance business, and it has started to branch out into private businesses. They have a segment called Markel Ventures, which is sort of their wholly owned subsidiary businesses. And that is a very difficult business, I think. What Buffett has built at Berkshire has always amazed me, because I'm not quite sure how he has been able to assemble a collection of companies that have been ever growing. The growing size of these companies have been ever increasing over the years. One of the largest railroads in the country in 2009. And yet they have continued to operate at a high level even after they've sold to Berkshire, which is not typically the case with a conglomerate. Typically, when you acquire a business, there are exceptions. There are some companies that have done very well at this, but my experience, my observation, when I look at conglomerates, there tends to be a lot of fat inside of that conglomerate, and there tends to be businesses that are not operating on all cylinders, so to speak. And so Berkshire has really been a remarkable thing. I think it's very difficult to do. So I don't think Markel, I wouldn't bet against Markel, but I think it's going to be tougher to replicate what Berkshire has done. I think it's much more, I would think of Markel much more of as an insurance company and much less of a Berkshire baby, so to speak. I've never really put Markel in that bucket. I've always thought the secret sauce of Markel is the simple equation of taking a profitable insurance company and using that as a way to invest in permanent duration securities, which are stocks. And very few insurance companies do that. Berkshire does it, Markel does it. There are maybe one or two other examples of insurance companies that do that to a certain extent, but those two do it very well. And Tom Gaynor, his genius is not in being a stock picker. It's in using that simple equation of, hey, if I have permanent capital and I invest permanent capital is the equity capital. If I have a profitable insurance business that's not going to require more capital, and I can grow the float over time, and I never have to touch the equity, then the equity should be invested in permanent duration securities. So instead of getting 2 or 3% in a bond portfolio, you can get 7 or 8% by investing in what essentially could be an S&P 500 fund. Now, he has historically done slightly better than that, but he certainly hasn't performed the way Buffett has. I don't think he ever intended to, because he runs a very diversified basket of stocks, whereas Buffett was Buffett started as a true stock picker and then sort of backed into an insurance company, whereas Markel is an insurance company through and through. And it's a very good insurance company. It's one of the best insurance companies in the world. And so that's the secret sauce, is just simply taking the float and the inherent leverage in that model and then buying stocks. And so instead of getting a return on equity that's 10, you get a return on equity that's closer to 13 or so. And that's why they've been able to compound their book value over time, is because they've added, 300 or 400 basis points to the return just through that simple formula. So I think that will continue, and it'll continue to be a great business. And you're right, it does have a longer runway. So it's so I don't own it right now, but I love the business. It remains on the watch list, and at times it gets fairly cheap.
I appreciate the very thoughtful discussion, John. We're coming up on time. If folks want to follow along or get in contact with you, how do they do that?
Yeah, they can visit my website, which is sabercapitalmgt.com, and they can read the writing that I posted, and I have all the archives up there, so they can read my thoughts on investing there, and then they can find my email address there as well.
And what's your Twitter handle?
Twitter is that's a good question, Toby.
It's John Huber 72.
Yeah. You got it. Yeah.
I'll link to it in the show notes.
I use Twitter. I'm not a frequent poster on Twitter, but I do post things from time to time. Every few days, I'll post something that's interesting. But yeah, I do use Twitter as a resource for uncovering news and uncovering information. So you can find me on there as well.
Well, I appreciate the time. John Huber, Saber Capital Management. Thank you very much.
Yeah, thanks, Toby. Thanks for having me on. Really, really enjoyed it.
My pleasure.